Welcome back to the Deep Dive. Today, we are strapping in for what might be, well, one of the most high-stakes, high-reward financial propositions currently out there, Banco BBVA Argentina S.A., known by its ticker BBAR.
That's right. And look, we're not just looking at any regional bank here. We're really dissecting an investment vehicle that's basically a highly levered, high beta bet on an entire country's economic turnaround.
Yeah, a huge bet.
The story isn't just confined to, balance sheets and lending rates. It's really about watching a central bank system unwind years, decades even, of profound monetary distortion and trying to pivot back to its core function.
Which is supporting private credit.
Exactly, supporting the real economy.
Okay, so our mission today is clear then. We need to understand the central investment thesis here. Is BBAR's model, this agile, digitally focused approach, is it truly ready to capitalize on Argentina's massive shift? This move from a state-dominated system to potentially a private credit boom.
And the flip side?
And crucially, what are the specific, almost existential risks that make this such a high beta proposition? The kind that could either fly incredibly high or, well, crash spectacularly. We've come through a pretty complex stack of source material, comprehensive investment analyses of BBAR's strategy, the latest financials we could get, Q1 and Q2 2025 data, and these massive critical regulatory changes shaking up the entire Argentine banking sector right now.
It really is a study in contrasts, isn't it? You've got this remarkably modern, efficient banking entity operating inside an environment that's historically been defined by chaos and, let's face it, chronic volatility.
Right.
So for us to properly analyze BBR, I think we first have to establish the context. We need to understand the fundamental macro shift happening in Buenos Aires right now. It's what analysts are calling the Great Banking Pivot.
Okay, let's unpack that. This fundamental macro shift. For decades, you're saying the Argentine banking system was, well, structurally forced into a kind of unnatural role, driven almost entirely by government needs. How did this historical model, the analysis called it crowding out, how did that actually work on a bank's balance sheet? And why did it starve the real economy of capital?
Well, you have to understand, it was basically a survival mechanism. It was forced by persistent macroeconomic distress. I mean, imagine trying to run a bank in an environment with chronic hyperinflation, incredibly high sovereign risk.
We're talking 100%, 200% inflation like in 2023.
Exactly, sometimes even higher historically. Banks simply couldn't make money lending to the private sector in that kind of environment. The risk of borrower default was just immense, and the real value of any long-term loan. It was constantly being annihilated by hyperinflation. You lend money out today.
And it's worth half as much in real terms a few months later.
Precisely. So lending to businesses, to individuals, it was just untenable.
So if that was off the table, where did the banks park all their deposits? They had to generate some returns, right?
They did. And they were basically funneled into this state-dominated financial structure. Banks focused almost exclusively on managing portfolios of high-yield, very short-term central bank debt. The key instrument here, you'll hear this a lot, were the LELIQs, l'unique de liquidez, or other similar government securities. These were incredibly attractive because they offered ultra-high yields, often protected, resetting every 7 or 28 days. They were essentially risk-free assets guaranteed by the central bank, the BCRA.
So wait, the government, through the central bank, was paying banks enormous interest essentially just to finance the government's own deficit, instead of those banks financing, say, manufacturing growth or consumer purchases.
That's exactly right. The banks effectively became quasi-treasury departments for the state. They were financing the government's day-to-day operational needs, not acting as true financial intermediaries for the private economy. And that concentration, all that liquidity and capital flowing into public sector debt, monopolizing the financial system, starving the private sector of credit, that is the very definition of crowding out.
And the result?
Private sector credit as a percentage of GDP just plummeted. It hit historic lows, crippling investment, crippling long-term growth prospects for the country.
Okay, which brings us to the present, this new paradigm, the crowding in, this radical transition. It's being driven by the Milei administration's stabilization plan, the shock therapy that kicked off late 2023. What are the absolute must-achieve goals of this stabilization effort, and how are they fundamentally re-engineering bank behavior?
Well, the goals are stabilization first and foremost. It's about achieving a sustainable fiscal surplus,
Right.
establishing predictable policies, and maybe most critically, driving down inflation expectations significantly.
Right.
The source material points to forecasts, like the IMF's, projecting GDP growth bouncing back quite strongly, maybe 4.5% in 2025, and average inflation slowing dramatically to around, say, 41.3%,
A huge drop from hyperinflation levels.
a massive drop. And as political stability seems to take hold, or at least the perception of it, and inflation expectations retreat, the central bank has moved very aggressively to slash policy rates.
Okay, and when the interest rates the central bank pays on those LELIQs and other government debt fall rapidly, those previously high-yield, risk-free parking spots for bank liquidity suddenly become, well, deeply unprofitable.
That's the trigger. That is the pivot point. Banks are just no longer able to generate those easy risk-adjusted returns from government paper anymore.
So they have no choice.
They're absolutely forced to redeploy those massive pools of liquidity assets that were previously locked up in public debt back toward higher margin private sector credit, simply to maintain their own profitability. That massive asset reallocation is the crowding in phase.
What's genuinely fascinating here, looking at the analysis, is the sheer scale of the opportunity this stabilization unlocks for a bank like BBAR. If the private sector was starved of credit for so long, are we potentially talking about a multi-year growth cycle here?
We absolutely are, because private sector credit as a percentage of GDP has been so depressed for years. I mean, levels far, far below any regional peer. This stabilization is unlocking what analysts consistently describe as a multi-year, very strong cycle of credit growth.
All that pent-up demand.
Exactly. Pent-up demand from corporations finally looking to invest, consumers seeking mortgages, car loans, durable goods financing. It's finally being unleashed. And for the agile banks, the ones that can move quickly, this represents a generational opportunity to build a high-quality, high-volume loan book.
Okay, so let's get specific then. How is BBI translating this huge macro shift into their actual business model, the revenue streams? The data we have from Q2 2025 suggests they're accelerating this pivot pretty rapidly.
They are acting decisively, it seems. The core pivot for BBIR is clearly shifting back to true financial intermediation, taking deposits and making loans. And the most compelling quantitative evidence we see of this acceleration is BBIR's total loan portfolio growth. It was up an impressive 15.7% quarter over quarter in Q2 2025.
15.7% in one quarter.
In one quarter. That demonstrates really aggressive, successful deployment of capital. It's clear evidence they are capturing the early stages of this credit boom, arguably faster than many of their more entrenched peers.
Okay, let's drill down into net interest income, NII. The source material notes that NII in Q1 2025 was around ARS 541.3 billion. But the future dynamics seem complicated. There's this significant tug of war described involving two countervailing forces. Can you walk us through the mechanics of that tension?
Absolutely. It's crucial. The first force is the immediate negative pressure. Rapid disinflation driven by the central bank's policy. As interest rates fall sharply, it causes margin compression on the bank's existing asset base.
Meaning those legacy government bonds.
Exactly. Those legacy, high-yield government securities now have to be repriced or replaced with lower-yielding assets. This inherently puts downward pressure on NII because the spread, the difference between the bank's lending rate and its cost of funding, shrinks.
Okay, that makes sense. But I imagine the success of the whole strategy, the whole bull case, hinges on the second force overwhelming that first one.
That's the entire growth story right there. That margin compression on the legacy assets, it's expected to be more than compensated for by the sharp and sustained increase in private sector loan volume.
So it's a volume game.
Think of it this way. A bank might suffer, maybe, a temporary reduction in the percentage margin it earns on each dollar lent out. But if it suddenly lends out 3 or 4 times as many dollars to the private sector, especially in higher margin areas like consumer credit, the total NII, the absolute amount, grows significantly. BBR's agility in driving that volume growth, that 15.7% QQ number we saw, that's the critical success factor.
We also have to highlight the quality of their fee income. Analysts often view this as, a more sustainable, less capital-intensive revenue stream compared to just pure interest income.
Yeah. Net fee income is a really crucial, high-quality part of BBR's profit profile, and it directly supports the valuation thesis we'll get to. In Q1 2025, net fee income hit ARS 99.8 billion.
Okay.
But the real story there is the momentum. That number represents a 48.3% increase quarter over quarter.
48%, quarter over quarter.
Quarter over quarter. And look, this staggering growth rate isn't random. It's presented as a direct operational consequence of their very specific digital strategy.
How so?
Well, these digital platforms enable high-volume, low-cost customer acquisition and then the instantaneous cross-selling of numerous fee-generating services, insurance, wealth management products, transaction fees, you name it. It's solid evidence that their operational engine is genuinely optimized for generating high-quality, recurring revenue streams.
That tremendous growth in fee income, it brings us perfectly to what seems to be BBR's core competitive edge. Its position as the undisputed digital leader in the market, according to the analysis. How much of this advantage is down to their own internal innovation versus leveraging the global tech resources of their parent company, BBVA Group in Spain?
It's definitely a powerful combination, but you have to say the backbone really is the parent company. BBR leverages BBVA Group's world-class technological platforms, their deep intellectual property in digital banking, and their sophisticated risk management frameworks developed globally.
Right.
This allows BBAR to operate what, we might call a fintech with a large balance sheet model. And this approach promises potentially massive operating leverage, that ability for revenue growth to consistently outpace the growth in operating costs over time.
And the efficiency metrics they cite, they seem almost unheard of for a traditional South American banking entity.
They really are the metrics that define the modern bank, aren't they? The sources confirm this extreme efficiency. An astounding 84.5% of new customers are acquired digitally.
84.5%.
Yeah, which means much lower overhead per customer entry. And maybe even more critically, 95% of all retail units, that's everything from credit cards to personal loans, investment products are sold digitally.
95%.
This isn't a bank that just, added an app as an afterthought. It's described as a digital sales machine, fundamentally designed to acquire and serve customers at minimal marginal cost, without really relying on an expensive physical branch infrastructure for basic transactions.
And that parental backing, it isn't just about the tech, is it? The source material highlights that the 66.6% controlling ownership by BBVA Group also provides a kind of strategic security and maybe regulatory comfort for investors.
Absolutely. It's a huge intangible asset, especially for foreign investors looking at Argentina. The parent provides dual oversight. So not only is BBAR subject to local Argentinian regulators, but as a key subsidiary of a major European bank with an NYSE listing, they also adhere to SEC standards and international governance best practices.
Aha.
This ensures a level of corporate transparency and sophisticated risk management that's absolutely crucial when you're considering investing in a historically high volatility market like Argentina. That confidence factor is a real differentiator.
Okay, turning to the competitive landscape then.
Yeah.
BBAR is clearly agile, but we do have to acknowledge, based on the numbers, they are not the market incumbent, not the biggest player.
That's vital context for anyone listening. BBAR is not the largest private bank by static market share. That title belongs to Grupo Financiero Galicia, GGAO. They're the overall market leader with roughly 13% of private loans. BBI holds a strong but definitely secondary position with 9.9% market share in private loans and about 8.0% in private deposits, as of the latest data we have, Q2 2025.
Okay, so given that they are smaller in overall market share, why are analysts so intensely focused on BBR's performance during this critical pivot phase? This seems to be where the competitive agility really shines, particularly when we compare its profitability to a major competitor like Banco Macro BMA.
This is highlighted as BBAR's definitive advantage in the analysis. Let's look closely at that critical transition period, Q1 2025, right when the stabilization shock was really hitting the system hard. BBAR delivered a strong annualized return on average equity ROAE of 11.4%.
11.4% ROAE. Okay.
Now compare that directly to Banco Macro, BMA. For the exact same quarter, they reported a remarkably weak annualized ROE of only 3.8%.
Wow, 11.4 versus 3.8. That's a threefold divergence in profitability. It's staggering, especially when the macroeconomic conditions were identical for both banks. What explains that massive performance gap?
Well, the source material is pretty explicit on this. BMA's own management attributed their poor results directly to, quote, lower income from interest on government securities.
Also the LELIX again.
That's the smoking gun, right?
Yeah.
It exposes BMA's slower pivot. It's presented as proof of BBAR's superior agility in rapidly shifting its asset base. While BMA was apparently still heavily weighted toward those large, declining yield public assets, maybe because their systems or processes couldn't pivot fast enough, BBAR had already successfully moved that liquidity into nascent, higher margin private credit lines, largely using their digital infrastructure.
So they maximized returns precisely during that tough period of monetary change.
That's the argument. They were faster off the mark.
It sounds like the difference between, say, a legacy bank that has to retrain thousands of branch managers to sell new loan products versus a bank that can just push a software update and instantly make those new products available to millions of existing digital customers.
That's a great analogy.
Yeah.
Exactly. The digital platform allows for near instantaneous changes in product mix, in pricing strategy, which is just invaluable during a structural shock like the one Argentina is going through.
Okay, let's quickly summarize the peer landscape then, just to get a clear picture before we move on.
Certainly. So you've got GGAL, Grupo Financiero Galicia. They're the market leader, described as highly diversified, and they boast that powerful Naranja X fintech platform, giving them excellent reach, especially in consumer finance.
Okay.
Then there's BMA, Banco Macro, often called the national champion. They're distinguished by a very extensive physical branch network. That's seen as a key advantage for deposit gathering and service delivery, particularly in the vast interior provinces outside the main capital region.
All right, the physical presence matters there.
And finally, BBAR, positioned clearly as the digital leader, competing primarily on capital efficiency, speed of execution, and superior technology leveraged from the parent.
Now, here's where I have to push back a bit based on the data provided. The analysis notes BBAR's Q1 2025 efficiency ratio was 56.3%. Now, that is demonstrably worse. Higher is worse for efficiency ratios than BMA's 33.9% and GGL's 43.1%. If BBAR is the supposed digital leader, why is their operational efficiency ratio lagging so significantly behind the competition? Isn't that a massive contradiction to the whole narrative?
That is a brilliant point, and it's probably the main counter-argument you hear against the immediate digital thesis. However, the analysis we reviewed suggests this might be a temporary contradiction that actually supports the long-term claim.
How does that work? Higher costs support the claim.
Well, the argument is that the higher ratio of 56.3% reflects the fact that BBAR is still carrying the heavy, front-loaded costs of its major strategic investment in digital. They are pouring capital into R&D, deploying new digital infrastructure, constantly optimizing platforms. These are significant fixed costs that hit the profit and loss statement immediately, depressing the short-term efficiency ratio.
Okay, so the interpretation is they're spending a lot of money today to build a system that will ultimately be much cheaper to run tomorrow.
Precisely. They've already reached that point where 95% of their sales are digital. That implies the marginal cost of acquiring and servicing the next customer is approaching zero. So the theory goes, once this heavy investment phase tails off, that currently high spending ratio should drop dramatically, unleashing the operating leverage we discussed earlier. The lower current ratios of GGAO and BMA might actually reflect less aggressive ongoing investment in future tech, or perhaps just legacy cost structures that haven't yet felt the full benefit or cost of a deep digital transformation. BBAR is essentially making a big bet on its future cost structure, accepting a higher cost today for what they believe will be a significant, sustainable operational advantage in, say, 2 or 3 years.
Okay, so we've established the bank's operational machinery seems incredibly efficient, or at least is designed to be, and it's strategically positioned for this pivot. But, operational strength is kind of meaningless if you can't actually realize the profits, especially for foreign investors. Historically, the primary structural barrier here was the infamous CEPO, Argentina's incredibly complex web of capital controls.
The CEPO, yeah, that was the absolute key structural barrier. It undermined the value of basically every single Argentine asset, from bonds to stocks, certainly for international investors. In essence, it made BBAR's potentially massive local profits into trapped cash.
Trapped cash.
Even if the bank made billions and billions of pesos locally, the parent company, BBVA Group back in Spain, couldn't easily or freely convert that cash into euros or repatriate dividends through the official foreign exchange market at a predictable rate. So the subsidiary was, as you said, a theoretical profit machine, but in practice, a cash grab.
But the analysis we looked at details what sounds like a truly monumental de-risking event, something that completely changes this equation based on regulatory changes enacted in 2025. What happened?
This is potentially the moment where BBAR shifts, in the eyes of international capital, from being just a speculative local stock to a viable, potentially cash flow generating asset for ADR holders, the American Depository Receipt holders. The central bank didn't just vaguely ease capital controls, they seem to have provided explicit, legally sound mechanisms. The critical regulatory change explicitly permits the distribution of dividends to non-resident shareholders, crucially, for profits accrued after January 1st, 2025.
Okay, can you explain the mechanism there? Why does that specific date, January 1st, 2025, matter so much?
Well, the date is essential because it draws a very clean regulatory line in the sand. Profits generated before 2025 under the old regime are still subject to potentially complex, uncertain repatriation rules. But new profits generated under this new stabilizing regime, are treated completely differently.
How so?
The central bank apparently created specific protocols, new regulations, guaranteeing access to the official foreign exchange market, the MULC, for these new earnings, provided the bank meets certain compliance checks and capital adequacy standards. This fundamentally transforms the way the parent group, BBVA Spain, likely views BBAR. It changes the subsidiary from just an accounting entry where the real value is effectively held hostage into a potentially reliable source of hard currency dividend income.
That sounds like a fundamental re-rating driver right there. A theoretical profit machine becomes a genuine cash flow generating asset. That could justify a significantly higher valuation multiple over time. And this regulatory relief, it couldn't have been better timed, could it?
No, it couldn't. And it coincides, almost perfectly it seems, with a major strategic catalyst that really demonstrates the management team's proactive approach, their ability to execute large-scale deals, even amidst all this policy uncertainty. The Stellantis joint venture.
Right, the Stellantis JV.
Yeah.
Walk us through that strategic move. What exactly is BBR doing with Stellantis, the auto giant, and how does this fit into their overall digital and growth strategy?
Yeah, this looks like a perfect example of BBR playing offense, not defense. In November 2025, BBAR received the final regulatory green light to form a 50-50 joint venture with Stellantis Financial Services Europe. And the explicit goal is to acquire FCA Compañía Financiera S.A.
Which is?
That's the captive auto financing arm linked to major Stellantis brands like Fiat, Chrysler, Jeep, Peugeot, etc. in Argentina.
Okay, and why is auto finance specifically such a critical focus area for them right now?
Well, it seems to hit two strategic sweet spots simultaneously. First, timing. It's perfectly timed with the projected economic rebound we talked about, that potential 4.5% GDP growth forecast for 2025. Durable goods, especially automobiles, are almost always one of the very first sectors where pent-up consumer demand just explodes after a long recession or period of high volatility.
Yeah.
People delay buying cars.
And now the demand is potentially massive.
Exactly. Second, the structure of the deal. This joint venture provides BBAR with direct, captive access to a high-demand auto loan origination pipeline. This is really crucial strategically.
Why captive?
Because BBR doesn't necessarily have to spend huge marketing dollars or compete aggressively on price in the open market to win these specific auto loan customers. They gain potentially secured, high-quality, high-volume loan originations right at the point of sale through the extensive Stellantis dealer network across the country.
That's clever.
It strategically positions the bank to sort of front-run the expected surge in durable goods credit demand, securing an entire category of potentially high-quality assets almost instantly. And remember, auto financing is also traditionally lower risk than unsecured personal loans because the loan is secured by the vehicle itself.
Okay, this really does seem to validate the confidence analysts have in the management team. They're not just sitting back, waiting for the macro environment to magically heal itself. They're making pretty aggressive strategic moves to secure market share in what look like the most profitable segments emerging from this turnaround. All right, now we need to shift gears, out of necessity really, to understanding the capital structure and, importantly, the inherent volatility and risks involved here. Let's start with the good news, though. BBR's capital base is often described in the analysis using terms like fortress capital. What exactly defines that financial strength?
Yeah, the strength is definitely visible in the ratios. BBIR maintains what looks like an exceptionally high capital base. This provides a massive buffer to absorb potential shocks, yes, but maybe more importantly right now, it provides offensive fuel for rapid loan growth.
Offensive fuel.
As of Q2 2025, their Tier 1 capital ratio was reported at 18.4%. Now, to put that in perspective, regulatory minimums are significantly lower, often around 10–12% depending on the specific measures, and BBIR's ratio substantially exceeds that of most regional peers as well.
So that much capital means they are essentially sitting on a pile of dry powder. They don't necessarily need to go out and raise new equity or expensive debt to fund that huge 15.7% quarterly loan growth we discussed earlier.
Yeah.
They have the internal capacity to fund a pretty sustained credit boom.
Absolutely. It gives them maximum strategic flexibility, which is key in this environment. And beyond just the capital levels, their current asset quality also looks extremely strong, though we absolutely must emphasize. Asset quality is often a lagging indicator, especially coming out of a crisis like Argentina's.
Right, things look good now, but
Exactly. But for now, the NPL, the non-performing loan ratio in Q1 2025 was an exceptionally low 1.38%. That's significantly better than the overall banking system average in Argentina, which was around 2.0% at the time.
and they're being prudent about potential future risks too, right?
The
Good.
provisioning. They seem to be. They are described as highly provisioned. Their provision coverage ratio was 164.3% in Q1 2025. What that means is, for every dollar of currently recognized bad loans on their books, they have already set aside about $1.64 in provisions to cover potential losses.
Okay.
This is also well above the system average, and it demonstrates or suggests that they are actively anticipating and preparing for future credit losses that are likely to come with the normalization cycle we'll discuss.
Okay, now for the volatility factor. This is where the analysis gets really complex, almost mind-bending for someone not used to it. BBR is subject to mandatory non-cash application of IAS 29 hyperinflationary accounting. For you, the learner listening, can you provide a clear, maybe illustrative example of why this specific accounting rule makes reported earnings so incredibly volatile and basically renders standard price-to-earnings PE ratios unreliable for analysis?
Yeah, this is absolutely essential to grasp if you're looking at BBAR or really any Argentine company right now. When an economy is officially designated as hyperinflationary by accounting standards bodies, companies must restate all their non-monetary assets, things like property, equipment, even some investments and historical costs based on the current purchasing power of the currency at each reporting date. And crucially, this is a non-cash adjustment.
Okay, an example.
Let's use a tangible one. Imagine BBAR bought a piece of land back in, say, 2023 for 100 million pesos. If cumulative inflation ran at, let's say, 200% over the next 2 years, the mandatory IAS 29 adjustment would force the bank to report a non-cash accounting gain of 200 million pesos on that asset, just to restate its carrying value on the balance sheet to 300 million pesos in current currency terms.
Even though they didn't sell the land, no cash changed hands.
Exactly. No cash gain at all. But that 200 million peso non-cash gain hits the reported net income figure on the P&L statement. This dramatically inflates or deflates the reported profit number, making it essentially useless for standard PE analysis because the E in PE isn't reflecting real operating cash flow.
Okay, got it. Completely distorts the picture.
Now, here's the paradox mentioned in the analysis. As the stabilization efforts hopefully succeed and disinflation takes hold, meaning inflation slows down, the rate of this mandatory inflation adjustment also slows down. Analysts often have to build high inflation forecasts into their models. If the actual inflation rate comes in lower than the high rate they used for the adjustment calculation, the mandatory adjustment booked is less negative than they anticipated. Or sometimes it can even flip entirely to being a positive contribution to earnings.
Which is exactly what the analysis said happened in Q1 2025.
Correct. The analysis noted that BBAR's reported profit surge in that quarter was derived in large part from a less negative hyperinflation adjustment than the market or analysts had perhaps expected. This non-cash surge can make the bank look monumentally profitable on paper, even if the underlying operating cash flow was just, say, steady or growing moderately. It completely breaks the PE ratio as a useful valuation tool because the reported earnings number is so heavily influenced by this artificial non-cash accounting figure.
Wow. Okay, and if that wasn't complex enough, there's yet another layer of volatility that the parent company, BBVA Spain, faces. The thing called currency translation drag.
Right. This is the final hurdle, particularly for international investors looking at the ADRs. BBAR, of course, reports its operational performance in Argentine pesos, ARS. But when BBVA Group back in Spain consolidates those peso results into euros or dollars for their own foreign parent company reports, a volatile, or more likely, a depreciating peso can create a significant P&L translation drag.
Spinning.
Meaning even operationally superb results reported in ARS can look weak, flat, or sometimes even negative when they're translated back into euros or dollars at a less favorable exchange rate. This can obscure the bank's underlying local operational strength from the perspective of international capital markets looking at the parent company's consolidated figures.
Okay. We started this deep dive by calling BBAR a high beta bet. Let's circle back now to the single overarching risk, because it feels like everything else we've discussed. The digital advantages, the strategic JV, the high capital, it's all kind of tertiary or dependent on this ultimate risk factor.
It absolutely is. The entire investment thesis fundamentally is an extremely high-risk, high-reward call option that is inexorably and for the foreseeable future permanently linked to the sustained success of the Milei administration's stabilization plan.
No escaping that.
None. Argentina's economic and political history is unfortunately littered with promising reforms followed by abrupt policy reversals. A failure of the current stabilization program, whether that means a return to interventionist policies, significant social unrest derailing reforms, or a sudden resurgence of high inflation would likely lead to catastrophic consequences for the banking sector.
Like what?
You'd see soaring credit losses, a potential credit crunch freezing lending again, further currency collapse, and likely a total reversal of the positive value proposition we've been discussing for BBAR. All the digital efficiency in the world cannot insulate a bank from systemic country risk of that magnitude.
Right. And beyond that huge macro chaos risk, we also have to seriously consider the inevitable risk of just credit normalization. As strong as that 1.38% NPL ratio looks today, why does the analysis suggest that management fully expects this number to increase, maybe significantly?
Yeah, it's described as an anticipated and almost necessary headwind of stabilization. The current extremely low NPL ratio is seen as partly artificial, a relic of the hyperinflationary period.
How so? Artificial.
Well, think about it. Persistent high inflation previously acted as an implicit subsidy to debtors. It constantly eroded the real value of their outstanding peso-denominated debt. Paying back a loan became easier over time in real terms. In a stabilizing environment where inflation falls dramatically, that subsidy disappears overnight. So, as the rapidly growing new loan book, remember that huge 15.7% quarterly growth begins to season. As borrowers have had these loans for a while, they will be forced to service the full real value of their obligations in a low inflation world. This increased real burden will naturally put stress on some borrowers, leading to a normalization, which really means an increase in NPLs from their current exceptionally low levels.
So paradoxically, stabilization itself creates near-term credit risk.
In a way, yes. It reveals the true underlying creditworthiness that was masked by inflation. This is seen as the price of achieving stability, and BBAR's prudent provisioning, that high coverage ratio, is supposedly anticipating exactly this expected increase in bad loans.
Okay, let's try and dedicate some serious time now to the tricky question of how one actually values a bank operating under these hypervolatile conditions, especially with the accounting distortions. We've established pretty clearly that standard PE multiples are basically useless because they're so heavily distorted by those large non-cash gains or losses from the IAS 29 inflation accounting.
Exactly. PE is non-functional here. You really can't use it reliably. The focus, therefore, has to shift to a more stable anchor, something less affected by those non-cash P&L items, the price-to-book, PB ratio.
Price to book. Can you just remind us what that captures?
Sure. It simply compares the current market price of the stock to its accounting book value per share. Book value is essentially the bank's assets minus its liabilities, theoretically, the net equity that shareholders would receive if the bank were liquidated today. It's seen as less susceptible to the wild swings of temporary non-cash earnings adjustments.
Okay. And the sources we looked at place BBAR's current PD ratio somewhere in the range of approximately 1.3x to 1.7x book value. How does that specific ratio compare to its main private sector peers in Argentina, like GGAL and BMA? And what does that comparison tell us about the market's current level of belief or maybe skepticism in the BBAR story?
Well, comparing those PB ratios, it clearly tells us that the market is not yet fully recognizing or rewarding BBR's perceived operational advantages or its superior recent momentum. BBAR appears to be trading at a tangible discount compared to its main domestic private peers. Grupo Financiero Galicia, GGAL, trades at a significantly higher ratio, reported around 1.9x PB, and Banco Macro, BMA, is also higher, close behind GGAL at around 1.8x PD.
Okay, hang on. That seems counterintuitive. If BBAR delivered that stellar 11.4% ROAE in Q1 2025, absolutely blowing BMA's 3.8% out of the water during a critical period, why on earth is BBR trading at a discount on a price-to-book basis? Shouldn't the market be rewarding that superior profitability and momentum with a higher multiple, not a lower one?
That is the core tension, the central question, really, underpinning the entire investment thesis. The market is clearly baking in a greater degree of skepticism or perhaps a higher risk premium specifically for BBR, possibly for a few interconnected reasons highlighted in the analysis.
Gotchas.
Well, first, BBAR, being a subsidiary of a large foreign entity, BBVA Spain, might be perceived by some local or regional investors as having less entrenched political insulation or maybe less national champion status compared to the truly local players like GGAL or especially BMA. Politics still matters immensely in Argentina.
Okay, perceived political risk. What else?
Second, the market might be looking at BBAR's incredibly aggressive 15.7% quarterly loan growth and thinking, okay, that's great now, but it means they're likely taking on more risk faster, and they might suffer a more severe NPL normalization curve down the road, which could erode future profits more than peers who are growing slower.
So pricing in higher future credit losses due to faster growth.
Potentially. And third, maybe most importantly, the discount could reflect the market's assessment, right or wrong, that BBAR's ultimate capital allocation decisions, its risk appetite, are ultimately guided or constrained by its large, conservative European parent company. This might introduce perceived limits on pure local risk-taking compared to locally managed entities like GGAL, which might be seen as having more autonomy.
Interesting. So the parent is both a strength, tech, governance, and potentially a perceived weakness, constrained risk-taking.
Exactly. In essence, the market seems to be pricing in a higher implicit risk premium or maybe just lower expected stability or upside capture, specifically for BBAR, despite its apparently best-in-class operational performance recently.
Okay, this really sets up the critical twofold thesis that seems to define the long-term investment outcome here. It relies partly on internal execution by the bank and partly on external stabilization of the country.
That's it. Factor one is earnings growth. This is the part BBAR can largely control through internal execution, successfully expanding its high-margin loan book, really leveraging its digital superiority to keep operating costs low over time, and maximizing risk-adjusted profitability. And we have seen some strong evidence, like the Q1 ROAE and the loan growth, that this execution is already happening.
Okay, internal execution is step one. What's step two?
Factor two is multiple expansion, or re-rating. This is the element of the high beta bet that is almost entirely external to the bank's day-to-day operations. It's the macro story.
This is the bet on Argentina itself succeeding.
Precisely. This is the bet on the country finally achieving durable stability. The thesis is, as Argentina's economic stabilization plan proves itself to be durable and sustained over several years, and as that crippling country risk premium structurally declines, the price-to-book multiples of all these Argentine banks should logically re-rate.
Meaning their market valuations should rise.
Should rise sharply, theoretically, to begin converging with their regional peers who operate in more stable markets. Think banks in Peru, Colombia, maybe even Brazil eventually. The investment in BBAR, therefore, is really a leveraged bet that this country-level re-rating will happen, amplified by BBAR's unique potential, due to its digital edge, to grow its underlying book value and earnings faster than its domestic competitors during that recovery phase.
Okay, let's try and unpack this simply for you, the learner, listening at home, because it's complex. What this deep dive into BBAR seems to show is a company with arguably a best-in-class operational engine. You see that in the 95% digital sales, the superior agility during the pivot phase, perfectly positioned, it seems, to capture a potentially generational shift in credit cycles in Argentina. But, and it's a huge but, its entire fate, the ability for those profits to actually be realized by foreign investors and for the valuation multiple to expand significantly, rests ultimately on two absolutely critical factors. First, the irreversible regulatory removal of those cash-trapping capital controls, the SAPO, which seems to be happening for new profits.
Yes, that's key.
And second, ultimately, on achieving sustained political and economic stability in Argentina itself.
Yeah, and what's truly fascinating here, I think, is how that internal strength interacts directly with the external risk. We talked about BBAR's exceptionally high capital ratio, that's strong 18.4%, tier 1 number. That's clearly its key defensive buffer. But if we connect this to the bigger picture the transition Argentina is going through, it raises a really important question that you, the potential investor, must constantly monitor.
Which is?
When an economy transitions this rapidly away from hyperinflation, how does BBAR's management effectively balance the intense short-term pressure from the market, maybe even from the parent, to aggressively deploy all that massive capital into new high-growth loans to capture market share? How do they balance that against the long-term inescapable risk that those very same newly originated loans will inevitably push the NPL rate significantly higher, away from its current artificially low level? How aggressive can BBR really afford to be in funding growth when the ultimate gatekeeper, the ultimate determinant of success or failure, remains the profound volatility of the Argentine state itself?
That fundamental tension growth ambition versus deep-seated country volatility, that really is the absolute core of the high beta bet, isn't it? And probably a perfect place to wrap our deep dive today. Thank you for guiding us through this incredibly high-stakes landscape.
It was my pleasure. A fascinating case study.
And thank you for joining us for the deep dive. We'll be back soon with more insights from the cutting edge of finance and analysis.